Traders quite rightly are obsessed by this notion of finding winning trades. That, after all, is the nature of our business. But the business has, at its core, an essential problem, and that is, how do we manage all the information that we receive as traders? When it comes to making a decision, we're constrained by three components: our cognitive ability, the quality of the information we receive, and the time we have in which to make a decision. None of those are infinite, but one of them is out of step with the others, and that is the information we receive. Traders nowadays receive information much like trying to drink from a fire hose. There is this torrent of noise, and somehow you have to manage that noise in such a way that you narrow down your opportunities to a select few that you perceive give you an edge. The problem is that because of the obsession with finding winning stocks, traders put that at the top of the pyramid of the decision making. This is incorrect. Picking a winning stock or picking a winning trade of any sort, irrespective of the market you're looking at, is actually a second order decision. It comes after other decisions. And this is often very difficult for traders to accept, because the assumption is that if you can pick the right stocks, then you'll automatically make money. As we'll see at the end, that's not quite correct. There is a nuance to that protocol that you need to be aware of. Picking the right market is a first order decision, and picking the right stock follows on from this. So it's very much dependent upon this notion of being able to pick the right market. And I want to use the current run in gold as an example about how we might go about beginning this process of filtering information so that we narrow down opportunities. To begin the process, I downloaded some data from a local website, marketindex.com.au. This information is freely available. What they do is they break down commodities into those stocks that mine, manufacture, or have exposure to this particular commodity. We have to be a little bit careful here because it's not as cut and dried as we might think. For example, companies might have exposure over a range of commodities. So when you look at something like stocks that are ostensibly in some way, shape or form connected to gold, you might not be getting a company that purely concentrates on, let's say, gold mining. And so we have to just be aware of that, and that will become obvious in a few moments. So what I did initially was I simply downloaded the data, and I've taken the top 20 by market cap, because the initial idea I wanted to look at was, is there a relationship between return and market cap? And on first pass, you can say with some degree of confidence, sort of. And it's very important that we don't make any definitive judgments about what we're seeing, because the unfortunate thing about trading is that what happens with traders is they trade their emotions and not what they see. And so you might be linked to the emotional idea that big companies always do well, small companies always do poor. And we have to be aware of those selection biases. And so we can see that sitting at the top of the list is BHP with a market cap of 227 billion. Now, BHP is not a strict gold play. It's very much a diversified miner. So this falls into that category I mentioned before of stocks that cover a wide range of activities. So we need to bear that in the back of our mind. But looking at this in a cursory way, we can see that there is somewhat of a relationship between return and market cap. So if I were trying to make my way through the hundreds of stocks that supposedly have exposure to gold here in Australia, my first step might be to begin to try and sort them on market cap. An issue we face now with the availability of PCs is that the PC will rip through a selection of stocks as a list very, very quickly and throw up candidates. The problem is not all candidates are equal. And so we have to find a way of narrowing that criteria down so that we get candidates that are useful, serviceable, but more importantly, tradable. So in manipulating the data, I've simply taken the same 20 stocks again, but this time I've reordered them by their 1 year return. And you can see a relationship does start to develop. We can see that there are very high returns in stocks that have a market cap of between $1 and $4 billion. So all of a sudden we've got a selection criteria that we can begin to work with. What is interesting though is the notion of those stocks at the bottom of this list. The Regis, the Gold Road, the De Grey, the Zimplats, and how poor their performance is. And this is something to be aware of when looking at these commodity-based stocks. It's not as simple as saying gold is going up, buy any gold stock. There is a subtlety in there that you need to be aware of, and there will be stocks within this commodity group that do very poorly, as we can see. And so we have to be aware of that when we're building these selection criteria. But as a proof of concept, if you're coming up with the idea that market cap big is good, then by definition, market cap small is bad would also be true. To confirm this notion, I took the same bulk list that I got from Market Index and I looked at those at the bottom of the list in terms of performance. And the bottom 20 show an interesting pattern. What is also interesting is that in Australia, you can have a company that is listed on the ASX, which has a market cap which is the equivalent of about what you would pay for, let's say, a reasonable house in Melbourne or Sydney. As an aside, it's quite intriguing that the ASX allows such shit to be listed and not simply removed. But if we go back to our proof of concept that market cap is an important criteria for selection, we can see here that those with very small market caps did very poorly. And I'll talk about a few reasons as to why that might be in a moment. But we need to get to the point where we are selecting stocks. It's all well and good to be playing around with data and to have a few ideas that we might want to apply. Here I've taken the same list and all I've done is pick those stocks that were the top performers, the top 20 based on performance, because I want to come back to this notion of, is having a larger market cap a good thing for a selection criteria? Does it in some way, shape or form assist us in generating a universe from which we can begin to select candidates? And the qualified answer is yes, but with exceptions. And the exceptions I've noted here in yellow, and you can see these are stocks that all have a market cap of under $50 million. So this is the price of an expensive home in Melbourne or Sydney. Still very, very small, not only on a world scale, but also on a local scale. In green, I have noted those that have a market cap above 1 billion. So we can see if we were to offer the hypothesis that I am looking for gold stocks that have a market cap of between, let's pick a boundary, 200 million and no upper range, then you would give yourself this capacity to be involved in a potential universe where opportunities arise. And we can see there is an exception there at the top of the list, and that's Australian gold and copper, with a market cap of only $64 million, which is quite small. But sitting underneath that is Red 5, which sits at 1.63 billion. So we do have this very mixed bag, and we need to be aware of this. One of the things to be aware of with trading systems is their job is not to catch every possible opportunity that floats by. Their job is to exclude stocks from the selection criteria. To perhaps put it dogmatically, the role of a trading system is not to find trades, it's to stop you taking trades that have less than optimal opportunity for you. That's a difficult thing for traders to perhaps get into their head. They believe that a trading system's job is to spew up vast reams of opportunities, all of which are brilliant. That's not true. We have to somehow manage the information we are receiving. And unfortunately, that means that occasionally we will miss trades because we have to have cut-off points. The only way to get every opportunity that the market is throwing up is to simply buy every stock on the market. And that's completely impossible to do. But I want to circle back to one of my original points, and that was right market, right time. We've looked at this notion of whittling down opportunities within a market, and in this instance, we've looked at the notion of market cap. Here, I've used market index again, and I've generated a list of, on the right, the top performing lithium stocks over the past 1 year. Here we see that problem of cross-pollination, this inability to strictly define what a company may or may not do. In that Wildcat appears at the top of both lists. This is a quirk of the Australian market and a quirk of the classification scheme we use for allocating terms to what a company might do. What is apparent here is that the top 20 gold stocks by far and away outperform the top 20 lithium stocks as a universe. You could throw a dart at the top 20 list of gold stocks and still outperform all bar 2 lithium stocks, and one of those lithium stocks is classified as a gold stock. So your chances of picking a lithium stock that would outperform any of the stocks on the gold list are quite poor. Here we have this notion of right market, right time. You may be the world's best lithium stock picker. Doesn't matter. It's an irrelevancy. Lithium's not going anywhere, so it doesn't matter how good your stock picking is, what your narrative is, what your technical analysis is, what your quantitative analysis is. If the market's not moving, the market's not moving. You're in the wrong place at the wrong time. And that's not where we want to be. An edge is generated by being right place, right time, which means being in the right commodity. By doing that, you are conferring an edge to your trading system, and it's a global edge. Yes, you still have to go through the process of selecting trade candidates, but you're doing so from a basket of potential candidates that already have positive momentum. That was not the case with lithium. You can see the performance for lithium stocks for the past 1 year, and remember, this is the top 20 performers. It's not a random list, it's actually ranked on their performance. It's very, very poor. You're not getting the drive that we got with gold. So I want to come back to this notion of why do we think market cap might be an important selection criteria? Why is size important? Because with market cap comes things such as liquidity and price discovery. So as a rule, size counts. It just does. And it does so for a few reasons. The first and most obvious is institutional involvement. If you're Bob's Dog mining stock from WA and you have a market cap of $2 million, you are not going to attract investment from the largest investors in the country. It's simply impossible. They can't get set. It would be impossible for them to get set. But there is a momentum effect based upon this. If your company gets to a sufficient market cap that it is included in the All Ordinaries, all of a sudden you become a potential vehicle for investment for those funds whose mandate allows them to invest in companies only within the All Ordinaries. If once you're within the All Ordinaries and you get bigger and you move into the ASX 300, you're now an opportunity for companies whose mandate allows them to invest in only the 300. The same would occur if you get bigger and you're moved up into the 200. So along the way, there is a ranking system that attracts interest. And that ranking system is very important to the price discovery and price trajectory of these particular stocks. And you can at times actually see where companies have been moved up an index and they become available to funds who may or may not be able to invest at them when they're in a lower tier. It's important to remember that large funds don't just blast out and invest in everything. They have mandates that allow them to invest only in certain segments. The larger you get, the more attractive you become because you attract institutional investment and you get into this feedback cycle. There will always be exceptions. If we go back to our list here, we can see there are stocks with very small market caps of 20, 25 million, even down to 9 million that did very, very well. But they require a different form of trading and a different form of engagement to other stocks. And you need to be aware of that. So you come back to an even higher order decision of working out what sort of trader you are. And so there are always exceptions. But you cannot build an edge on exceptions. That's impossible. An edge is built on the statement of something occurring on average over time. The mere fact that you are an outlier means that you have failed the test of on average because you are an outlier. And you can't rely upon exceptions to build a trading system. It needs to be built upon the firm foundation of rules that you have tested and observed over time. There is also an issue of trade management that occurs when you're looking at stocks of different sizes. With market cap comes liquidity, comes price discovery. All of these aid in the trade management process. It's important to realise that when you look at these league tables, they are a little bit deceptive because you will never get the 825% that Wildcat generated. You may get a portion thereof, and your job is to be as efficient as possible in achieving that. And that efficiency is aided by size. Liquidity and price discovery aid trade management because it makes your entry and exit easier, but it also makes strategy such as pyramiding easier because there is always a pool of willing buyers for you to sell to and sellers to buy from. You don't have these large gaps in price. So we come back to this notion of right market, right time. We want to be in the right market. We want to be in a market that is moving. And that's our first order decision. Secondly, we want to have a mechanism that in some way, shape or form allows us to select from that pool of candidates. So we might end up with a list initially looking like this and have to decide where our cutoff points are. What's the low point? What's the high point? But the most important part of this is this notion that we are in right market, right time, as seen by these two comparative lists. Being in the wrong market at the wrong time is the job of stockbrokers and financial analysts. It's not the job of traders. As traders, we want to try to find a path to the list I have here on the left, because it is that list on the left that is the one that is the wealth generating list. The one on the right might be an ego-based list. You can say to yourself, well, look, I picked, a very good lithium stock. Nobody cares. The only way the market keeps score is whether you're able to turn up the next day because you're profitable and whether you are able to take advantage of the opportunities that the market presents.
Before you leave, don't forget to like the video and subscribe to our channel.